Today, we're tackling three big questions on every investor's mind: how global geopolitics is reshaping markets,
If you go back into history across different ages, when any typical king and a kingdom which has become too large to sustain itself, the king normally directs the attention of his subjects to some external threat or outside the borders, as we call it. Thus, under Mr. Trump, what we are seeing is that USA is doing something similar.
why Indian earnings lag despite strong policy support,
India's saving as a percentage of GDP has come down. At the same time, Indian household debt has also gone up as a percentage of GDP. Yes, the market did get ahead of itself, and then it has been waiting for this policy to actually translate into better growth in the coming quarters.
and whether 2026 marks a genuine turnaround.
We saw a good recovery across sectors in the recent quarterly earnings season, and now therefore we expect that Nifty earnings can average around 15% CAGR over FY26 to 28.
Market Thalaivas brought to you by Sundaram Alternates.
Welcome to another episode of Market Thalaivas, where sharp minds decode sharp moves. I'm your host, Aishwarya, and today we're tackling three big questions on every investor's mind: how global geopolitics is reshaping markets, why Indian earnings lag despite strong policy support, and whether 2026 marks a genuine turnaround. To take us through this, we're joined by Mr. Darshan Engineer, who brings over 17 years of experience across equities and credit, with deep insights across sectors like auto and auto ancillaries, pharmaceuticals, IT, chemicals, and consumer discretionary. So, Mr. Darshan, welcome to the show.
Thank you, Aishwarya. Thanks for inviting me to another session of Market Thalaivas.
Thank you so much for joining us. So, let's kick off with the big picture. How do you look at calendar year 25?
Yeah, so before we begin, on behalf of Sundaram Alternates and myself, I wish everyone listening to this call a very happy and a prosperous new year. I hope CY26 brings health, happiness, and positivity to all of you on both personal and professional fronts. Coming to your question, the Indian market did have a very volatile year in CY25. So there were some months which exhibited strong negative returns, and then there were months which gave very strong positive returns. Overall, through all of this ups and downs, we saw that the Indian large cap benchmark indices, basically Nifty 50 and BSE Sensex 30, closed CY25 on a positive note with around 10% return. However, our returns were lagging other major global and Asian peers. Interestingly, there was a lot of divergence between different segments of the market. So while large caps, which were basically represented by Nifty and Sensex, were up around 9 to 10% for the year, mid caps, which represented by say NSE mid cap 150, was up around 6%, whereas small caps represented by NSE small cap 250 was actually down 6% for the year. So there was wide divergence between different market cap segments. Interestingly, there was a wide divergence between sectors as well. So traditionally, some sectors which are generally not liked by the investing community, except maybe some mutual funds, such as metals, oil and gas, and maybe PSUs, they were interestingly up around 10 to 25% for the year, whereas traditionally favored sectors like FMCG, consumer discretionary, IT services, they were actually down 5 to 15% during the calendar year 25. Then there were some sectors like auto and BFSI which did moderately well. Now, this divergence and moderation in returns was driven by several factors, some of which I'm just trying to highlight over here. One, there was a pronounced downgrade cycle in corporate earnings throughout the year, with only some improvement seen in the last few months. There was visible deceleration in the banking system credit growth because of RBI's strict measures in earlier years. Our Indian markets have always been very richly valued, and that also played a factor in the modest returns. Globally, the tariff situation continues to remain uncertain, and especially against India. Because of all this, FII outflows have been sustained and have been negative for a while now, and India's relatively high valuation multiples don't help here. And also, the last year has seen the rise of AI-led investing and themes on AI, where India does not have much of investment options. So overall, the macro environment does remain challenging. Our USD INR has crossed 90, which is a psychological level, according to me. The domestic liquidity is again tightening despite the rate cuts and the supportive RBI actions. The 10-year bond yield for Indian market has gone back above 6.6% despite the rate cuts. So our FII and FPI investors remain very cautious with outflows seen even in January 26. I think they are awaiting clarity on the tariff and other geopolitical situation. In contrast, the domestic flows remain resilient. They have provided much support to our markets. However, their resilience will also be tested in the coming year because they have also not made money. And at the same time, what we have seen is that the precious metals have been on a good return generating spree, and which is what is also causing a lot of incremental flows to go to the precious metals like gold and silver rather than into equities. So that's broadly what I would say, how I would summarize the past calendar year.
So you touched on geopolitics, but before we get into India-specific questions, I wanted to understand the current global macro landscape. There's a lot of upheaval happening globally. Can you try to simplify it for our audience and how it's impacting various markets in different ways?
Sure, I think geopolitics is very interesting at a very interesting juncture right now. So if you see, January 2026 actually had started on a positive note. I mean, Indian markets were recovering and a lot of the beaten down stocks of the past few months had recovered. But within the first week itself, there emerged new geopolitical tensions, most notably the US operation in Venezuela, where in a very swift move, the US captured President Maduro of Venezuela and brought him to US shores. And at the same time, Mr. Trump has been very aggressive on various global affairs, not just in relating to Venezuela, but also Greenland, Iran, and against Russia, China, India, and so on. So we are seeing a very aggressive stance by Mr. Trump. Now, we need to go back into history to understand why this is happening. See, if you go back 70 to 80 years ago, under the last uh, post the World War II, there has been a steady framework where US has acted as a consumer to the world, while other countries, most notably China, Southeast Asia, and other emerging countries also acted as low-cost producers to the US and the other developed markets. Now, what this led to was large trade imbalances where US had to run large trade deficits and the producing nations were running large trade surpluses. Now, how was this being balanced in a very simple manner? The US dollar was acting as the default reserve currency to the world. And that is why, despite the big trade deficits, US could continue to run those trade deficits. They could run up trillions of dollars of unsustainable debt without defaulting, as USD was the currency under which it was being measured, and therefore US could simply print lot more dollars and continue to grow based on a consumption economy. However, the Ukraine war in 2022 was what triggered the first sign of the current situation. In September 2022, after 6 months had already passed for the Ukraine-Russia war, the US and the Europe decided to freeze Russia's forex reserves, which were mainly dollar denominated, in an attempt to cut short Russia's war funding. But that meant that the US reserves by various central banks were no longer safe. Most large global central banks realized that we can no longer trust the Western economies to not disturb this part of the ecosystem. And that was for the first trigger for the structural bull market in gold. Now, we have interestingly covered this detail on why the gold prices have rallied in a earlier market Thalaivas session. You can refer to that. Coming back to this question of yours, so also what has happened in the past few decades is that the middle income USA, which is mainly the Midwest and the interior parts of US, feel left behind by this current global framework. They feel that they have become poorer. They don't feel good about globalization and a networked world economy. US President Mr. Trump basically represents this sentiment of the middle USA, and he is therefore taking steps trying to arrest the slide of the US in the recent years. Hence, he has been aggressive on multiple fronts. One, he's trying to bring back industry to USA. He's trying to reindustrialize USA through multiple methods. One is incentives, others is threats, tariffs. He's also trying to expand territory. Or obviously, he's not saying that I am going to acquire countries, but the intent is very clear. This actually goes back into, if you go back into history across different ages, right from the beginning of civilization, when any typical king which has become and a kingdom which has become too large to sustain itself, and when they face internal challenges and they are unable to come out of this problem that they have with quick and easy solutions that satisfy the domestic audience, the king normally directs the attention of his subjects to some external threat or outside the borders, as we call it. Thus, under Mr. Trump, what we are seeing is that USA is doing something similar. He is imposing tariffs unilaterally against countries which don't follow or don't bow down to him. He gives incentives in order to get people follow his approach. If that doesn't work, he then tries to become aggressive in a territorial way. Now, if you see what is happening, tariffs and incentives haven't really brought back industrial jobs in a big way. Tariffs, while we have not seen US inflation rates going up as yet, but tariffs are working their way through and gradually pushing the domestic inflation in USA again higher. And that is the reason why US Fed has not been cutting rates fast enough and has been very circumspect about cutting rates further, despite pressure from president. So, what is Mr. Trump doing? He is being aggressive globally. He is assisting Ukraine in its war against Russia. He has overthrown the Venezuelan government. We had big support from Russia, China, and Iran. He is acting against Iran with support from Israel. And finally, he is insisting that Greenland should be a part of USA. And you can imagine, Greenland is actually a part of Denmark, and Denmark is a part of European Union. And in turn, it is also a part of NATO, where European nations and US are partners and friends of each other. Now, what this means is that his aggressive style and stance on various matters has eroded the trust of the world on US and the US dollar as a credible reserve currency. People no longer have the same trust level on its institutions, especially the US Fed. US Federal Reserve used to be like the gold standard of backstopping various risks that emanate in the world markets. The fact that the sitting US Fed chairman in a press conference has pointed out that the current judicial inquiry against him is politically motivated further strengthens the view which is already emerging in the market that US institutions can no longer be viewed as credible. And that is the big reason why we have seen a sharp rally in precious metals like gold and silver, including even other metals like copper and aluminium. It has also meant is that equities as an asset class have bore the brunt, and which is why in the last few weeks we have seen significant volatility, especially in emerging markets, including even in US markets now, where markets have corrected and are up 1% or down 1-2% on a daily basis. What we are witnessing is that the world is shifting from a US centric order to a multipolar one. Now, this is being driven by multiple reasons such as a rising sovereign debt, monetary realignments, and geopolitical tensions. Mr. Trump's actions against Venezuela have actually made it easier for China to take some action against Taiwan in future. We don't know when it will happen, but now it is. Why will China not do it in future? Similarly, even other emerging powers in various geographies will try to consolidate that dominance in regional geographies, like for example, Russia in Eastern Europe, Middle East, maybe see a renewed action by Saudi, Turkey, Iran, and there can be lot of upheaval in that region. And US is trying to dominate the entire North and South Americas as well. We also have to understand a bigger, longer term problem apart from, of course, this various near term geopolitical issues, that the advanced economies are facing fiscal challenges from an aging population. They don't have a good replacement rate of their population, and therefore, high inflation is a way out for them to reduce their unsustainable debt. Therefore, in the longer term, actually BRICS nations, including India, will gain from our lower debt levels, a much younger population, cheaper energy, and gold-backed resilience. But in the near term and maybe even in the medium term, we will have to go through sharp volatilities in our markets as well.
All right, thank you so much for sharing. Let's now shift our focus to Indian markets. Looking back at 2025, we had rate cuts, liquidity support, tax changes, all the right policy moves, but earnings never really showed up. Was this just policy taking time to filter through, or did markets just get ahead of themselves?
Yeah, that's an interesting question. See, in view of the global tariff wars, especially against India by US, our Indian government decided to undertake a series of structural initiatives and reforms. For example, it decided to cut GST rates in late September 2025, whereby for most consumer goods, the rate cuts came down from 18% to 5%. In February 2025, in the annual budget, it announced lower in personal income tax rates. It also recently, in November December, announced labor reforms in order to industrialize India more. And it also targeted various sector specific reform such as insurance, energy, maritime infrastructure, including shipbuilding. So there have been a host of reforms that have been undertaken by the government. In parallel, the Reserve Bank of India, our central bank, also pursued an accommodative monetary stance through interest rate cuts, systemic liquidity infusion, and liberalization of the lending framework. So, a host of positive changes have been taking place by government as well as by the Reserve Bank. However, why this has not yet percolated to the economy, we have to understand, we have to go back again into history. You see, post COVID, our economy has seen a K shaped recovery. Now, what do I mean by K shaped recovery? If you look at the income pyramid of Indian population, the upper part of the income pyramid, which is basically the rich and the upper middle income, they never really suffered much during the COVID and post COVID. They retained their jobs. In fact, because they had a good wealth base, they saw a sharp increase in their financial wealth, leading to a wealth effect, and which has translated into strong demand for high-end consumer discretionary spends. At the same time, the bottom part of the pyramid, they actually suffered after COVID. Many of them lost their jobs, or they had to work at stagnant salaries or wages, and therefore they have had to dip into their savings pool, which is anyways low, or in some cases, because they had depleted their savings pool, they had to borrow and resort to debt in order to manage their household and continue living on their meager incomes. Therefore, India's saving as a percentage of GDP has come down. At the same time, Indian household debt has also gone up as a percentage of GDP in the last 5 years. So, this strong policy support from government and RBI, it will take some time to percolate into the real economy and reflect into better demand and earnings growth for listed corporates. See, equity markets are always forward looking. Therefore, they tend to price in this changes expectations immediately and then wait for the actual events to unfold. Till the time that doesn't happen, the market tends to be in a range or it corrects, which is what we have seen that yes, the market did go get ahead of itself, and then it has been waiting for this policy to actually translate into better growth in the coming quarters.
Staying with earnings for a moment, after months of downgrades, we're finally seeing some stabilization and early upgrades. From where you sit, is this just a short breather in the cycle, or does it feel like the start of something more durable?
Very interesting question. See, this is typical of any market, and especially in case of India. Uh, Almost every year at the beginning of a financial year, various sell side and buy side firms come out with hopeful earnings growth for the various sectors based on guidance from management and based on various macro indicators. People build in certain earnings estimate for the immediate financial year and the next financial year. Thereafter, what happens is that as the year progresses, based on actual events and evolving macro situation, every quarterly result season leads to some cut in the earnings estimate for the current year and the immediate next year as well. Then, therefore, the market also tends to pivot, factoring in various valuation multiples and other indicators. So, this is typical of any Indian market. in the past also, we have seen earnings downgrade cycle happening almost every quarter over the past few years. Interestingly, Q2 FY26 result season was the first in many quarters of the past where we have seen that earnings downgrade cycle is seeing a moderation and maybe it is coming to an end. We saw a good recovery across sectors in the recent quarterly earnings season. The month of November and December saw upgrade in various sector companies, especially leading to an upgrade in the Nifty earnings estimate. Some of the sectors which saw some better upgrades were automotive, metals, banks, and IT is also seeing some improvement gradually into their earnings estimate. And now, therefore, we expect that Nifty earnings can average around 15% CAGR over FY26 to 28. Now, this will be mainly driven by sectors like banks, where after a period of cleanup of their balance sheets, they will start to see an improved earnings profile. In the raw material cost had come off in the recent past. Corporate capex had been done, but it had not yet translated into earnings. Now, with improvement in utilization and demand, their earnings growth should also start to recover. And after a few years of slow IT services growth, we are seeing that the base is quite benign, and therefore it should also see an improving earnings growth. Now, the recent geopolitical turmoil and therefore the associated run up in commodity prices again causes a near-term drag on profit margin. So we may see again slight decline in the gross margins and therefore the profitability of various commodity commodity input companies, like for example auto or consumer durables. They may see again some drag on profit margins by, and therefore it may lead to a delay in earnings recovery again by a few quarters. So the things remain volatile. But yes, I am quite hopeful that in the coming quarters, we will see a much more durable and a better earnings growth profile than what we have seen in the last, I would say, 4-5 quarters.
All right, now let me bring credit into this. Banks are in a much better shape. Rates are down, and some of the excesses have been cleaned up. As we head into 2026, does this growth come back because people want to borrow again, or because banks want to lend again, or do we finally see both happening together?
I had highlighted earlier that the bottom part of the pyramid had leveraged itself to fund its spending during the last few years. But what it also led to was a lot of subpar or poor quality lending by banks and NBFC. And therefore, in order to ensure systemic stability, the RBI had tightened the screws in 2024 itself. And therefore, what it led to was a subsequent period of slow growth among banks and NBFCs. There was asset quality issues emerging in unsecured loans such as microfinance, personal loans, credit cards, and RBI's liquidity tightening as well as higher rates had led to a significant slowdown in these segments. Now, what we are seeing is that once that asset quality and the growth has been slowed down, lending has been curtailed. After that, under the new RBI governor, once that desired effect has taken place, what we are seeing is a reversal of the policy cycle. So what we are now seeing is that RBI has now cumulatively cut repo rates by 125 bips in CY25, and therefore it is going to lead to an easing of the lending cycle again. So what we saw was that it initially went through a slowdown. Now with the rate cuts and some easing in the regulatory stance, we are going to see a acceleration in credit growth in the coming year. Already the quarterly result season of Q3 FY26 is showing good trends for some of the NBFCs and the banks which have come out with results. Longer term, what will drive acceleration in credit growth? One, corporate comeback. Because of lower interest rates and higher capacity utilization, companies are going to start reinvesting in capacity addition, and therefore we are going to see borrowing of loans by corporates in order to fund their future growth plans. Banks, from bank side, balance sheets are cleaned up. Their gross NPAs have fallen to a decadal low of around 2%. Credit costs have normalized, are low for many banks in some NBFCs, and therefore it provides comfort to these banks and NBFCs to grow much faster again, which obviously comes with better ROE also, because once growth comes back, it absorbs a lot of the fixed costs, leading to much better ROA and ROE. And finally, post the sharp slowdown in retail credit, what we are seeing is that retail credit will also revive, especially in interest rate sensitive segments like home loans, vehicle loans, and MSMEs. Now, I just want to highlight one very important and interesting trend that has been observed in the last, I would say, 6 months. India is one of those few markets where lending growth can continue to grow at healthy rates for the foreseeable future. Where there are very few large markets like India available globally. So, US is already an over-leveraged country. China is also quite leveraged now, and India is one of those few large markets where lending and the borrowings is still much lower compared to other markets, and therefore India can continue to grow at much higher rates. And this is what we are leading to what we call a global money magnet scenario. What I mean by this global money magnet, the BFSI sector in India has seen massive capital infusion from across from several overseas investors. So in 2025, almost $15 billion came from overseas investors to acquire majority stakes or controlling stakes in private banks and certain large NBFCs. Chief beneficiaries included Yes Bank, RBL Bank, Shriram Finance. In fact, Shriram Finance received almost more than $5 billion from uh, MUFG recently from Japan. So, what this it means is that it reduces the cost of borrowings for these banks or and NBFCs structurally, and in turn they can start focusing more on growing and diversifying their operations and expand their base of operations as well. So naturally, all of this means that the lending business in India will continue to grow, both on the from the demand side, because people and corporates will start to borrow again, and at the same time, banks also have a much better balance sheet, and therefore they would also be willing to lend again. So it will be a combination of both.
Which brings us to the consumer. With tax relief, lower EMIs, and the 8th pay commission, households could see a real income boost. Do you expect that money to be spent, or are people still likely to save or invest rather than consume?
Again, I go back to the same income pyramid explanation. The upper part of the income pyramid never saw any impact, and they continued to spend and invest as per their needs. It was the bottom part of the pyramid where slowdown was visible, and therefore, post the policy support, they should have ideally started spending. But as I explained earlier, the savings pool was depleted. So therefore, the benefits from these policies, the wealth transfer schemes, and as well as lower EMIs, lower tax rates, etc., it will first go in replenishing their savings pool. So I would reduce their borrowings. So once their savings pool has been replenished, they feel more comfortable about their personal financial health. They will embark on a renewed spending cycle. And therefore, on a weak CY25, where we did not see much improvement in consumer spending across categories, especially at the lower part, in CY26, we will see renewed spending and improvement in demand for various goods and services, but with some lag. So, as I told you, the recent upheaval obviously delays decision making among corporates as well as among the retail consumer, and therefore they will take maybe some months to recover. These measures by government can effectively inject almost 3.5 to 4 lakh crores into the hands of household, which means that the economy can shift from a stage of cautious savings to potentially active spending in the coming years.
And just to zoom out as we wrap up, India led global markets in 2025 despite strong long-term stories. What needs to change for India to move from being a steady allocation back to a leadership market in global portfolios?
Let us again go back to history for this. Post-COVID, in the last 5 years, Indian market has been a remarkable outperformer versus other emerging markets. For global investors, Indian market has delivered decent returns in dollar terms despite the INR depreciation. But we also have to understand that the Indian market has always been valued much richer compared to other emerging markets and even some developed markets. Now, therefore, when earnings growth slows down, as we highlighted earlier, and we saw in CY25 that the earnings growth was very tepid. Uh, at the same time, there are new investment themes like artificial intelligence and AI, generative AI. Here, India does not have much of a play. Therefore, investors tend to look elsewhere. For them, Indian markets have already made money, and therefore, like any fund manager, they would also want to book profits from a winning position, redeploy that profit into other markets which may be much cheaper and have a similar or even better earnings growth profile. Like, for example, in Taiwan, Korea, China, and even US markets, they have much more AI led investment themes, and they have a good market where earnings growth is similar to ours, but at much cheaper valuations. For instance, China and Korea were available at 10 times price to earnings multiple versus India, which was generally trading at around 20 times. So, therefore, for them, it is but natural to shift some of their capital from Indian markets to these global markets where they can see money making opportunities. And therefore, till that time, India and US don't arrive on common ground on a trade deal and on a broader framework, things will remain a bit circumspect. Therefore, that is also one reason why FIIs or FPI investors have remained on the sidelines, and they don't wish to deploy capital till a firm agreement is in place. At the same time, I am sure US also realizes that in order to diversify itself away from China, it will need India as a reliable manufacturing and services alternative. India has good macro stability, a stable government. It has a large domestic market which can consume some of the US goods, like, for example, soybean or corn and so on. So therefore, I mean, US also understands that a trade deal would be beneficial to US as well. So I think the trade deal is also one uh, event which is being awaited by investors. And once that happens, I think a lot of uncertainty will go away, and therefore you will see that India comes back into the asset allocation of large FII investors. And once that happens, you will see a reversal in various macro indicators such as improvement in our uh, current account part of the economy, as well as it will also help INR recover from the lows, and that may lead to a new initiation of a new bull market among in the Indian market as well.
All right, so perfect. Those were all the questions I had for today. We have a lot to look forward to for this year. So, a big thank you to Mr. Darshan Engineer for joining us today and sharing his insights on navigating this phase in the markets.
Thank you, Aishwarya. It is always lovely interacting with you, and your questions are always very interesting. Wishing everyone once again a very happy new year. Hope CY26 turns out to be a great year for our markets, and we get very great positive returns across various market cap as well as across sectors. Thank you so much.
All right, and as always, we hope you walk away with perspectives that help you think sharper and invest smarter. Until next time, stay curious, stay invested, and keep watching Market Thalaivas, powered by Sundaram Alternates. Thank you.